Good afternoon, everybody. This is Bob Brooks, host of the Prudent Money Radio Show. Had some technical difficulties on my side, and just seemed like you ever had a Monday on a Wednesday? Kind of this way it's been today. But anyway, talking to Dan Pilla, talking about the tax rates, the Tax Cuts and Jobs Act that President Trump passed in 2017, and it ends at the end of this year. What's going to happen? He talks a little bit about the politics of it as well. You get the full conversation of that. Unfortunately, though, you've missed the first 3 or 4 minutes, and I just cut in on the time that we're able to get the program recorded. So I hope you enjoy it. Listen, if you got any questions of me or want me to look over anything that get a second opinion from another advisor, whatever it might be, please make sure that you go to the website and send an email in, info@prudentmoney.com. Also, been talking to a lot of people who have been laid off, and lots of decisions to be made, and lots of questions that creates. I'm very available to help you if you need that in that situation as well. Just go to prudentmoney.com, and we'll take care of it. I hope you enjoy the show.
Jobs Act is going to survive. It's going to be extended, and there may be some circumstances under which the tax cuts are even deepened to the benefit of middle to lower income citizens. You know, Trump is talking about not taxing Social Security, which I think is a great idea, not taxing wages and not taxing overtime, which I think would be, both those things would be administrative nightmares, frankly. But you know, he hasn't abandoned the ideas yet. But the point is that Congress, the Republican Congress, has made it clear that they want to preserve the Tax Cuts and Jobs Act and even make it better. And so I agree. I think we're going to see something favorable.
Talk a little bit about this. This to me is such a random idea to not tax tipping. Where do you think?
Yeah, it is a random idea. It's really a random idea, and the problem with it, again, is purely administrative in terms of how do you administer a rule like that? What constitutes tips, and are employers going to now take the position? For example, Bob, are you going to take the position with your employees there in your office that said, I'm not paying anybody a salary anymore, but you do a darn good job, and I'll tip you nice, and all of the remuneration that goes to your employees is now in the form of tips and not wages.
Right.
You know, how is that going to be defined? How is it going to be administered? How is the IRS going to be auditing everybody now, every business owner, to determine whether this payment was really in fact for wages or whether it was in fact a free gift for tips? And is it only going to? And the other problem is it only going to apply to the service industry, waitresses and waiters and bartenders and service personnel, and if you're going to confine it to the hospitality industry, right, where you have waiters and bartenders and so on, well, why do their services that get remunerated in tips, why are those beneficial when the Uber driver or the food grocery delivery person, they're not in the hospitality industry, but they get tips. The pizza delivery guy that brings the pizza to the office, he gets how are you going to distinguish between all this stuff? I think it's very, very problematical, and I think it's going to be very difficult to administer if it gets passed.
I do like anything that helps Social Security, but it makes me wonder if this kind of sets it back for a couple of reasons. First of all, it takes away, obviously, tax revenue. I don't know how much at the grand scheme of things that is, but it also, could it motivate people to take early withdrawals from their Social Security before full retirement, which is not a good idea, especially if it's not taxed. What do you see in that?
Well, that's a good question, and the fact of the matter is that all taxes have consequences, as you well know. And so if Social Security is not taxed at all, I think that will be an incentive for some people to take their Social Security early. Of course, you take the Social Security early, you get a reduced benefit, right? You only get the full benefit when you reach your full retirement age. So you still have that disincentive to retiring early. And so that has to be taken into consideration. But the fact of the matter is, Bob, that, there's two sides of the coin to this, and people don't ever look at the other side of the coin with Social Security. But the one side that everybody recognizes is, hey, I earned money my whole working life. I was taxed on that income. I made that contribution to Social Security, and doggone it, that's my money coming back. Why should I be taxed on it twice? And that makes 100% sense, and it's easy to understand. And the core of the argument is correct. The other side of the coin is this: you pay in X dollars over the course of your working life, and when you start drawing Social Security, of course, you got to live to the next month to get the benefit, right? But what if you live 20 or 25 or 30 or 35 years after retirement? My father-in-law is into his 35th year of retirement drawing Social Security, right? So how much more money has he drawn out of the system than he ever paid in the first place? Should that money be taxed? Of course, the only way to figure that is figuring out A, how much you paid in over the course of your life, and then B, you could only start taxing it after that person reached the threshold of having drawn that much money out. Now, frankly, I believe, and I've never run the numbers on this, and maybe you have, but I believe the vast majority of people that draw Social Security don't ever draw back an amount equal to what they paid in.
I have never thought about running those numbers, believe it or not, but I would have to see what those numbers come out to. That would be interesting to know.
Yeah, it would be.
Well, let's talk a little bit about what the expiring provisions that directly hit the middle class. Talk about, because I really, and you probably agree with this, I don't know how that the vast majority of people understand how the standard deduction works. How's the dependent and exemptions? Talk a little bit about that as far as the current plan we've got right now and what that would look like if it went away.
Yeah, well, what happens is the standard deduction is an amount you get to deduct off your income that represents, a very, very fundamental level of providing for your support, right? It might be considered. I'm not sure exactly I'm not sure the numbers tie exactly, but it might be considered the poverty level, right? So prior to the Tax Cuts and Jobs Act, the standard deduction was roughly $8,300 for individuals, and married couples about twice that much money. And what the Tax Cuts and Jobs Act did is doubled it, right? It doubled it. And then what it did is it took away some of the specific itemized deductions that were allowed on Schedule A, which is some miscellaneous itemized deductions really is what was eliminated. But the vast majority of people never itemize their deductions anyway. So the fact that the standard deduction was doubled more than offset that loss of the partial itemized deductions. And if the Tax Cuts and Jobs Act goes away, it'll revert back to where the standard deduction is quite significantly lower, and not everybody's going to benefit from the fact that they add back the itemized deductions to a certain extent.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. IRS Expert Dan Pilla is here, as he is every month, to give us information and talk about what's going on in the world of taxes and the IRS. If you want more information about Dan, and he's got a great website with a lot of free information, incidentally, taxhelponline.com is where you go. What I wonder, and not that giving to church, for instance, is motivated everybody for the tax deduction. But I wonder if there's still people giving to the church, and they turn everything over to their CPA. They don't really look at it. They just sign it and send it in. They still think they're getting a tax deduction when most people can't itemize.
Well, you're right, and you're right on both counts. Frankly, the people that tend to contribute to churches and charitable organizations are motivated primarily by an altruistic drive Whether in the case of Christians, of course, they feel that their Christian responsibility to help their neighbor, which of course I believe it is, and they're doing it for that reason. And oh, by the way, there's a tax benefit, but I think the overwhelming majority of those people would give even without the tax benefit,
yes.
Which brings us to your second point, and that is, there's only about 25% of the tax returns that are filed, Bob, that itemized deductions, right? And it's even more so now under the Tax Cuts and Jobs Act, because as I said, the standard deduction doubled. For married filing jointly right now in the 2026 filing season, it's almost $31,000 worth of benefit without even a nickel's worth of itemization. So if you're giving $10,000 or $15,000 to charity, okay, great. Well, that doesn't exceed the $31,000 that you're getting with the standard deduction. But people are going to give anyway.
Yeah, it's a really interesting part of the puzzle when you look at it, and you kind of wonder what's behind the numbers. Talk a little bit about the standard deduction, the way it is now versus the way it was before. Which one definitely gives the taxpayer the best deal, do you think?
Oh, there's no question the structure that exists right now under the Tax Cuts and Jobs Act is more beneficial for the vast majority of tax return filers. There's no doubt about it. And for those that don't benefit from the increased standard deduction, well, they're itemizing anyway, and so their numbers are higher anyway.
Mm-hmm. Well, talk a little bit about individual income tax rates and what they did before and after.
Well, yeah, and this is the key to the key to understanding the tax breaks. The leftists ran around the country screaming tax cuts for the rich, and claiming that it was only the rich people that benefited from the tax cuts, and the reason for that is because the top rate dropped from 39.6% to 37%, and this is what caused them to cry tax cuts for the rich, right? Well, but the fact of the matter is that all of the brackets right in the core of the middle class went down as well. The 15% bracket went to 12%, 25% went to 22%, 28% went to 24%. 33% went to 32%. This is the core of the middle class. It's earning between roughly $70,000 a year and roughly $200,000 a year. This is where those rates fall, Bob, and they all dropped under the Tax Cuts and Jobs Act. So to say it was all tax cuts for the rich is just simply nonsense.
I don't know if I'm going to pronounce this right, and quite frankly, I've never heard of it. I read this in your article to the National Review. Talk a little bit about what exactly is is it P's limitations?
Yeah, it's P's. It's P's limitation. It's named after Democrat Congressman Donald Pease. And what Pease did is he's created this mathematical gymnastics exercise that allowed the IRS to diminish itemized deductions based on this calculation for people that earned income above a certain amount. So in other words, for every itemized deduction, every dollar of itemized deduction you claim, your itemized deductions were 3%, reduced by 3%. And what this was is just a clever scheme that would allow the IRS to increase, or Congress really, to increase your tax liability without increasing tax rates. All right, so the Tax Cuts and Jobs Act eliminated that and fully restored all of the itemized deductions that a person could claim regardless of what their income level was.
And, of course, another really big one that draws a lot of attention, a lot of debate, is the SALT deductions. Talk a little bit about that, and if you think that's going to make it in its current form.
Yeah, this is ironic. SALT is the deduction for state and local taxes. So the acronym SALT stands for state and local taxes, and there was a deduction allowed on Schedule A for state and local taxes, your income taxes, real estate taxes, sales taxes, and so on, that you pay. That deduction was actually capped under the Tax Cuts and Jobs Act, and so it was capped at $10,000. So this really was a direct detriment to high-income people, because high-income people are the ones that are paying the high state income taxes and the high real estate taxes because of the high values of their homes and so on, right? But it was capped, and so the benefit of the deduction was limited, and high-income people could no longer claim the full benefit of it. Well, the politicians in the in the high-tax states like New York and Massachusetts and California and Minnesota, they all went crazy, Bob. How dare they restrict this tax deduction? And they're the ones screaming tax cuts for the rich, but this one directly hit the rich in a negative way, right? Directly hit them in a negative way, and this is the one that the leftists were all crying about restoring. Well, it has come to pass now that the Republican representatives in the high tax states have been pushing Trump to eliminate the cap and restore it to full taxability, and it is to full deductibility. I mean, all right, and so it is likely that is going to be the case when the new bill goes through.
And of course, there's also debate on the child tax credit. If I recall this to be the case, child tax credit. How does that work?
Well, the tax credit, Bob, is worth more than a tax deduction. A tax deduction is marginal. So if you have, let's just say, $10,000 worth of state income taxes that you write off, and let's just say you're in a 25% tax bracket, right? So you got $10,000 worth of deductible expenses. It saves you $2,500 in taxes, right? So that's the marginal effect. A tax credit is dollar for dollar. So if you've got a $1,000 tax credit, that means your tax liability is reduced by $1,000. A credit is like somebody else paying your taxes. All right, so the child tax credit for those under the age of 17 went from $1,000 to $2,000. All right, and that is going to go away if the Tax Cuts and Jobs Act is allowed to expire. So it's a significant benefit for families that have young children, because it's, as I said, it's like somebody else paying your taxes.
Hey, Dan, I'm going to have to cut you off. We're at the end of the program. But hey, thanks for coming on board. TaxHelpOnline.com is where you go for more information. And if you need a question answered to me, go to the website PrudentMoney.com, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.